Welcome to the Deep Dive.
Yeah.
Today we're getting into something absolutely core to financial advice, maybe one of the biggest responsibilities out there.
Definitely.
Think about it. The level of trust that you place in an advisor. You're sharing the most private stuff, aren't you?
Oh, absolutely. Income, savings, health sometimes, family situations, debts.
Your hopes for the future, retirement goals. It's incredibly sensitive information.
It really is. It's a massive privilege to be trusted with that. And, well, it comes with a heavy legal and ethical weight.
Yeah, a huge weight.
Exactly. And the mission, really, for this deep dive is to kind of shortcut your understanding of the main framework governing this in the UK.
Okay.
We're talking about the UK General Data Protection Regulation, UK GDPR, which works alongside the Data Protection Act 2018.
Right.
And we're going to focus on the 7 core principles. These really set the standard you have to meet. For compliance, yes, but also just for building that client trust.
And let's be clear from the outset, this isn't optional, is it?
Not at all. No opt-out. This applies to every single advisor, every firm, every network, anyone processing personal data in UK financial services. It's mandatory.
Okay. So let's maybe pin down the scope a bit more. We're not just talking about bank account numbers, are we?
No, far broader. It's all the personal identity stuff, the financial details, of course, but also, crucially, the things said in meetings, you know, the context, the nuances.
The whole relationship is built on discretion, really.
That's the heart of it. Look, compliance with the rules, ticking the boxes, that's the baseline. You have to do that. But data protection, especially in this field, it runs deeper. It's fundamentally an ethical commitment.
Right.
If you mishandle someone's data, it's not just a potential fine from the regulator. It's a massive breach of trust. You've broken that professional promise.
That makes total sense. So the UK GDPR, with its 7 principles, it basically turns that ethical idea into, well, concrete operational rules.
Precisely. These are the building blocks, and you need to be able to show to your clients and definitely to the Information Commissioner's Office, the ICO, that you're following them.
Okay, so let's walk through these 7 pillars then. Maybe look at what they actually mean day to day for an advisor.
Sounds good. Let's start with number 1, lawfulness, fairness, and transparency.
Okay.
This basically means you have to be completely upfront. Tell people why you're collecting their information, how you're going to use it, and importantly, who you might need to share it with.
So no burying things in jargon or pages of small print.
Exactly. The client should never feel like they were misled or, didn't really understand what they were agreeing to. If they feel confused, you've likely already failed on transparency.
Okay, that seems straightforward enough. But then we get to number 2, purpose limitation.
Ah, yes. This one's key. It means you can only use the data for the specific reason you collected it in the first place.
Right. So give me an example. If I collect income details to assess mortgage affordability, I can't then just turn around and use that same sensitive income data to, say, push some unrelated investment product at them later on.
Not without getting fresh, specific consent for that new purpose. You can't just repurpose data like that.
That sounds like it could make things like, ongoing client relationship management or identifying other needs a bit tricky.
It adds a hurdle, definitely. It forces advisors and firms to be really specific about permissions. You can't rely on some vague catch-all clause in your initial agreement.
So if the purpose evolves, like moving from initial advice to ongoing reviews,
you need a clear, documented legal basis for that new processing. Often that means getting fresh consent again or having a very clear, legitimate interest explanation documented for why you need to use it that way. Very specific.
Okay. Which leads nicely into the 3rd principle, I guess. Data minimization.
It does. This one's about collecting only what is necessary and relevant for that specific purpose you just defined. Don't hoard data just in case.
But hang on, isn't there a tension here? Especially for financial advisors.
How so?
Well, the SCA, the financial regulator, demands that advisors gather enough information to demonstrate the suitability of their advice. That often means digging quite deep into a client's life.
Ah, yes, the classic tension. FCA says get enough detail. The ICO via GDPR says only get the minimum. It's a balancing act.
So how do you justify collecting, say, details about someone's lifestyle, their family plans, their hobbies, not just their bank balance? Where's the line?
The justification has to be explicitly linked back to the specific service being provided and documented.
Go.
So if you're doing complex, long-term financial planning, maybe even intergenerational stuff, the firm needs to clearly record why knowing those family details or lifestyle goals is necessary to give suitable advice.
Right.
But collecting, say, detailed medical history for a simple investment account, probably excessive. Collecting it if you're arranging life insurance, absolutely essential. The need defines the line, and you must document that need.
Got it. Okay, number 4.
Accuracy. Pretty straightforward, but critical. Personal data must be kept accurate and up to date.
And for advisors, inaccurate data isn't just a GDPR slip-up, is it?
Absolutely not. It's a massive risk. It could lead directly to unsuitable advice, potentially causing serious financial harm to the client. This means you need systems and processes to regularly review and update client information, especially when their circumstances change. Proactive, not reactive.
Okay, principle 5. Storage limitation. Basically, don't keep data longer than you need to.
That's the principle, yes. But this is probably the biggest point of friction in financial services.
Why is that?
Because while UK GDPR says delete data once the purpose is fulfilled, other regulations, particularly from the FCA, often require firms to retain records for long periods.
Right, like advice records, suitability reports.
Exactly. Often for 5 years, 7 years, sometimes even indefinitely for things like pension transfers. This is required specifically to handle complaints or regulatory checks later on.
So a client might ask to be forgotten under GDPR's right to erasure, but the FCA rules say you must keep their advice file. How does that work?
There's a hierarchy. The specific legal obligation to retain records, like the FCA rules, generally overrides the right to erasure for that specific data set.
Okay.
But, and this is crucial, you can only keep it for that mandated regulatory reason. The data should be effectively archived, securely stored, access restricted, and not used for anything else, like marketing or analysis.
So you have to document why you're keeping it, referencing the specific FCA rule, and lock it down.
Precisely. You explain to the client you can't delete that specific file due to legal obligations, but confirm it won't be used for other purposes.
Okay, that clarifies the conflict.
Yeah.
Let's move to security, which is probably what most people think of first with data protection.
Yes. Principle 6. Integrity and confidentiality, often just called security. Data must be protected against being lost, changed, or accessed or disclosed without authorization.
And this means computers and passwords.
That's part of it. The technical measures, things like encryption, secure servers, firewalls, multi-factor authentication, all vital.
But it's more than just IT, right?
Oh, definitely. The second part is organizational measures. This is about people and processes, staff training on data handling, clear policies for destroying old files securely, restricting who can access sensitive data within the firm.
So an advisor leaving a client file on a train.
That's a major breach, an organizational failure, just as serious as a sophisticated cyber attack causing a technical failure.
And the responsibility lies with?
The firm, ultimately, but also the individual advisor, has a personal responsibility for the physical files they handle, the emails they send, the devices they use. Both physical and digital security matter equally.
Okay. And the last principle, number 7.
Accountability. This ties it all together. It means the firm must be able to demonstrate that it complies with all the other 6 principles.
So not just doing it, but proving you're doing it.
Exactly. You need the policies written down, you need procedures in place, you need records of staff training, you need audit trails, you need evidence. If the ICO asks, you have to be ready to show them how you comply.
That makes sense. It forces documentation and process. Okay, so we've covered the 7 GDPR principles. Let's shift slightly to that related ethical duty confidentiality. The professional promise not to spill the beans.
Yeah, the bedrock principle of trust, really.
But there must be times when that promise can be or even must be broken legally.
There are, but there are very limited and specific circumstances. Only 3 main gateways, really.
Okay, what's the first one?
The most obvious. The client gives explicit consent. They clearly instruct you, usually in writing, to share specific information with a specific third party.
Like telling their accountant about an investment.
Exactly, or sharing details with their solicitor for estate planning. But the consent needs to be clear, informed, and specific about what's being shared and with whom. A vague nod isn't enough. Documentation is key.
Right. What's the second scenario?
This is where it gets more complex. Disclosure is required by law.
Like anti-money laundering rules.
That's the classic example. You might have a strong duty of confidentiality to your client, but you have an overriding legal obligation to report suspicions of money laundering or terrorist financing to the authorities.
And in those cases,
Yeah.
you often can't even tell the client you've made a report, right? The tipping off offense.
Precisely. The legal duty compels disclosure and often mandates silence towards the client about that disclosure. It supersedes confidentiality completely in those specific legal contexts.
Okay. And the third exception.
This one is about self-preservation, essentially. Disclosure is permitted if it's necessary to protect the advisor's or firm's own legal interests.
Meaning?
For instance, if a client makes a formal complaint or brings a legal claim against the advisor or firm, you would need to use their information, including confidential details, to defend yourself or respond to the claim properly.
Right. You can't defend yourself with your hands tied.
Exactly. But outside of those three narrow lanes, explicit client consent, legal requirement, or legitimate self-defense against a claim, that wall of confidentiality must remain absolute. No casual chats about clients, no insecure emails.
Okay, let's flip this now and look at it from the other side. As the listener, as the client, the data subject, what power do I have over my information once my advisor has it?
UK GDPR gives individuals, data subjects, significant control through a set of core rights. There are 6 main ones to be aware of.
Okay, let's hear them.
First, the right to be informed, basically. The right to know what data is held, why, and how it's used, tying back to that transparency principle. Second, the right of access. You can ask for a copy of the data held about you. This is often called a subject access request, or SAR.
Okay.
Third, the right to rectification. If data held about you is inaccurate or incomplete, you have the right to get it corrected.
Makes sense. What else?
Then, fourth, the right to erasure, famously known as the right to be forgotten, the right to request deletion of your personal data.
But we talked about the conflict here with FCA record-keeping rules.
Exactly. This right is not absolute. If there's an overriding legal obligation to keep the data, like those FCA rules, erasure can be refused for that specific data, but the firm must explain why, citing the legal basis.
Okay, so what are the last 2 rights?
Fifth is the right to restrict or object to processing. You can ask a firm to limit how they use your data or object to certain types of processing, like direct marketing. And sixth is the right to data portability, the right to obtain and reuse your personal data for your own purposes across different services, maybe transferring it securely to a new provider.
Got it. And for firms receiving these requests, especially those subject access requests, there's a time limit, isn't there?
Yes, and it's strict. Generally, you must respond promptly and usually within 1 calendar month of receiving the request.
1 month. That's not long if the data is complex or archived.
It's not. And failing to meet that deadline is a breach in itself, regardless of anything else. It's a key compliance metric for the ICO. Delaying can lead straight to regulatory action.
Which brings us to consequences. What happens if firms get this wrong? If there's a breach, or they ignore these rights?
The consequences can be severe. The Information Commissioner's Office, the ICO, is the UK regulator here, and they have significant enforcement powers.
Fines.
Yes, potentially very large fines, up to 17.5 million, or 4% of the company's total worldwide annual turnover from the preceding financial year, whichever figure is higher.
Wow, that's substantial.
It is, but honestly, often the immediate financial penalty, while painful, can be less damaging in the long run than the reputational hit.
How so?
A serious data breach, or being seen to disregard client data rights, can completely destroy public trust. Rebuilding that reputation, especially in financial services where trust is everything, can take years, if it's even possible. The loss of current and future clients can be far more costly than the fine itself.
A really critical point. Okay, let's try and wrap this up. We've journeyed through the UK GDPR framework, drilled into those 7 core principles, looked at the ethical duty of confidentiality and its limits.
Yeah, it's been a detailed look.
What's the main takeaway you'd want people to hold on to from all this?
I think it boils down to this. As an advisor, as a firm, you need to treat client data with the exact same level of care, diligence, and security as you would treat their actual money.
That's a powerful analogy.
It requires constant vigilance, robust systems, clear processes, and a culture of respect for privacy. Getting this right isn't just about avoiding fines. It's fundamental to your credibility, your integrity, and the sustainability of your business in this profession.
Well said. And perhaps a final thought for everyone listening to mull over. We live in an age dominated by digital systems, right? Cloud storage, automated advice platforms, instant file transfers, and at the same time, regulations like GDPR demand responses to client requests often within just 1 month.
Yeah, the pace is relentless.
So, The question to ponder is, what ongoing continuous operational changes must firms make year after year to successfully walk that tightrope? How do you balance the efficiency and speed of digital processing with the absolute non-negotiable need for watertight security and the ability to respond promptly and fully to clients asserting their data rights? That's the real modern compliance challenge, isn't it?
It really is. Constant evolution is required.